Here are 10 types of financial markets that you could profit off and make huge returns like Warren Buffett, John Soros, to name a few. Annuities. A lot of traders use annuities coupled with their retirement plans to make investments. Annuity are a contract with an insurance company that provides you with payments periodically. The payment duration and the amounts are both predetermined. Annuities are low-risk investments, but they are low growth as well. Returns depend on the contract terms and conditions. Number 9. Foreign exchange, currency exchange. Commonly known as Forex. Forex traders buy a currency that is expected to increase in value in the future. If they are correct, they make a substantial profit out of it. The profit all depends on the changes of prices and the lot size used. However, 90% of retail traders lose their money because they lack deep information on the markets. Successful traders include George Soros, who made over $1 billion of profit by analyzing the macro fundamentals of the pound and then sold it back in 1992. Many retailers do not do this and instead use only charts to predict future moves, hence having many losses compared to profits. However, we got a solution down in description. Number 8. Mutual funds. They refer to a pool of investors who are investing in several companies at the same time by buying stocks. These funds are either managed actively, in which the analysts choose the companies for the investors to put their money. They can also be passively managed, in which the fund tracks some stock market investment. There are also mutual funds, which are a mixture of actively managed and passively managed funds. They offer between 10 to 30% return on investments annually. Number 7. Certificates of deposit. One of the most secure kind of investments is a certificate of deposit. It involves you delivering cash to a financial institution for a fixed term, and as soon as the term is over, you could withdraw the cash along with your predetermined interest. Number 6. Cryptocurrencies. Cryptocurrencies are virtual currencies which have a marketplace value. Bitcoin and Ethereum are one of the major well-known cryptocurrencies. They rose after the 2008 stock market crash to protect against fiat currencies. They are backed by high-tech programs and computers to prevent hacking. Over the past few years, they have brought the rise of NFTs, which are digital arts, with some selling as high as $69 million. However, crypto may be an incredible volatile form of investments as their prices fluctuate tremendously. Number 5. Physical assets. This involves buying an asset that holds a market value that can be liquidated when you need the money. These assets can be precious metals, jewelry, property, businesses, to name a few. As in the case of most investments, investors who put their money here expect the prices to increase so that they can sell the asset at a higher price. Properties in form of real estate can offer passive income through rental payments. Number 4. Retirement plans. Most people are offered a retirement plan at either their workplace or some other means. Retirement plans are not exactly an investment category, but they can be thought of as a means to make other investments as they give you countless advantages such as tax leverages. And you can cash out once you retire at the age 50 to 65, depending on country. However, your retirement will be taxed from the principal amount. Number 3. Options. Options can be thought of as a complex kind of stock. An option gives you the ability to either buy or sell a certain asset at a predetermined price at whatever given time. An option may decrease in value and might end up in a loss for the investor. You may also end up in profit, an example being the famous trading stock market crash. Click video in description to find out who and how. Number 2. Bonds. Government bonds are the safest investments you can ever have. This is because they are insured by the government and central bank. However, being the safest, they offer the worst returns compared to the rest, with an average of 1 to 5% annually. Buying a bond means you are lending money to an enterprise that is either government-owned or is a business. Businesses issue corporate bonds, whereas the government issues treasury bonds or municipal bonds. Once you have held the bond for a particular time period and it reaches maturity, you can acquire the bond with interest. Bonds are generally a low-risk investment and come with lower returns as compared to stocks. Number 1. Stocks. Most people are aware of stocks. They are probably the most popular and simple kind of investment that has been around for a really long time. Basically, when you invest in stocks, you're buying a part of a share in a public trading company. Some of the biggest companies in the world today, such as Microsoft, Apple, Samsung, all sell their shares. However, they sell only a small percentage in the stock market. Once you buy the stock and the prices go up in the stock market, then you can sell the stock at a profit. Stocks also pay dividends, which are a percentage of their profits they give to you for owning a piece of their company. The downside is, if the price goes down, then you will go into a loss. If you wish to buy stocks, then brokers are the right people to get in touch with, as they will help you make an investment. Subscribe for more financial knowledge.